Guys, I want you to understand some big loan changes that are happening nationwide with mortgage companies pretty much everywhere. Loan companies are losing money now per deal. Check this article from just January 2023. It says like 600 per origination, but I mean, that's probably way worse now, now that I'm talking to you in late 2024. We basically had this, never-ending cycle of rates coming down over like a 30-year period. They don't have that anymore. So they've got to be smarter with their money. They've got to be a lot more efficient, and they got to be smart while still holding attractive rates to stay competitive. So I'm going to list a bunch of these things that lenders are doing now that I see in no particular order. But first one is they're starting to charge processing and underwriting fees to vets on VA loans. A lot of lenders like to not have to charge them, that $1,000 or $1,200 fee. Can't be as nice anymore. Number two, requiring buyers to pay for the appraisal fees up front before they've either been ordered or before closing. Sometimes lenders will be very nice and they'll just let the buyer pay them back for the appraisal that's happened during the process. But if the loan doesn't close, then the buyer really wouldn't even owe the lender anything if the lender paid for it up front. So absolutely no more of that. Main thing is lenders are cutting out a ton of processing, underwriting, closing, other back-end operations help. They always do this when loan volume contracts, but they also increase this when it picks back up. This is just a never-ending cycle. But this does affect turn times. If you're not going to have as much processors and underwriters, it can be a little tougher to get things through or slower. And some aren't just scaling back their operations, they're just going out of business altogether. I remember Draper and Kramer was a big one. I think they're like headquartered out of Chicago. They just said, forget it. They're going to throw in the towel, get out of it altogether. And they're also just selling themselves off to other bigger companies, big bank, take little bank. Another thing, I'm seeing increased origination fees. I mean, that's part of inflation too. You're not seeing like $1,200 or $1,295 origination fees anymore with everybody. It's closer to like $1,500 or $1,600 per loan estimate. They're also keeping servicing and or selling the servicing of their loans if they're doing servicing at certain time periods before when they think it's going to be more profitable to just sell off the servicing, get a lump sum payment from a new servicing company instead of collecting a small drip off of that every month, right when they think that loan itself is about to be refinanced and then closed out anyways. We're also having loan officers pay for license renewals. Those can cost like a couple $100 per state that a loan officer is licensed in, and they're not as willing to just pay for that for lenders anymore for like each state they want to be licensed in. Some companies will shave loan officer compensation, shave it down by like 5 or 10% per deal or per type of deal. No more happy hours or Christmas parties. Basically, no more fun. A lot stricter on reimbursements. Not just the debit card or credit card statement. They want to see the full receipt of what's going on, making sure that you're not just playing golf with your buddies and reimbursing it back. They're cutting marketing. They're cutting unprofitable loan officers, even though that happens in pretty much any market. They're getting into other profitable arenas, getting into HELOCs or having some type of deposit structure at their company, or maybe they're getting into reverse mortgages because those can be very profitable for lenders. And those aren't the Fannie Mae, Freddie Mac loans that get sold off. They basically, do those themselves. Some of them are literally taking out loans on their assets just to stay alive. It's like taking out a 401k on yourself. They're doing a lot. I mean, these companies, they intend to repay on this stuff in the future. They're betting that the refi market will come back. But the companies that have done this stuff earlier, they've made it through basically this post 2021 market a lot better. Early 2022 is when rates, took off from 3%. And but the more companies that make it through this, the stronger they're going to be on the other end. I'm sure there's a bunch of things that I missed here too, but you'll see a lot of this if you're a buyer or if you're an agent seeing your buyer go through some of these things. Like, it's normal now. It's not party time anymore like it was when you had that post 1980 inflation reduction period where rates for decades just came down. Guys, I appreciate you watching. Stay tuned for more. Please subscribe to the channel. I promise you there will be fantastic stuff here. A lot of extra topical videos that's going to teach you a ton about what's going on in the mortgage industry, the process of it, just different concepts to learn. And thank you very much.